How does raising interest rates control inflation? Inflation can wreak havoc on an economy, driving up the cost of living, reducing purchasing power, and creating uncertainty for businesses and consumers alike. Interest rate increases are a potent weapon that central banks can use to fight inflation. Even though the effects of increased rates might not be evident right away, this tactic is essential for slowing down the economy and containing price increases. In order to restrain excessive demand, slow down company expenditures, and decrease consumer spending, all of which fuel inflation, central banks try to raise the cost of borrowing. However, how precisely does this procedure operate? Interest rates and inflation have a complicated relationship that affects everything from consumer behavior to the overall state of the economy. To gain a better grasp of this crucial monetary policy tool, we will examine the 7 main ways that increasing interest rates contribute to inflation control in this video. 1. A decline in consumer expenditure. A decrease in consumer expenditure is one of the most obvious effects of interest rate increases. The cost of borrowing money increases when interest rates rise. For instance, when central banks raise interest rates, credit card rates, auto loans, and home mortgages all rise. When borrowing becomes more expensive, consumers who may have been considering taking out loans for large purchases or to cover their daily costs may change their minds. As a result of people and households being more frugal with their spending, consumer demand declines. A key component of containing inflation is reducing the upward pressure on prices, which is achieved by lowering consumer demand for goods and services. Businesses are less likely to raise prices to meet higher demand if consumers are spending less, which would result in slower price increases. In economies that are driven by consumers, this loss in demand is particularly significant. Runaway inflation, which is frequently caused by higher demand than the supply can satisfy, can be avoided by slowing down consumer spending. The economy may fix itself as demand declines, making price stability a more achievable objective. 2. Lowering investment in business. Businesses typically cut back on their investments when borrowing rates rise, just as consumers do. Loans are a common source of funding for new initiatives, inventory purchases, and business expansion. Businesses find it more costly to borrow money as interest rates rise, making it more costly to finance these endeavors. This frequently causes companies to postpone or reduce their investment plans. Particularly, capital-intensive sectors like manufacturing and real estate might be more severely affected. Businesses may decide not to upgrade their technology or build new facilities when borrowing becomes more expensive. Because there is less demand for commodities, labor, and materials as a result of lower corporate investment, prices in the whole economy is also less under pressure. There will be less rivalry for resources and fewer incentives for companies to raise prices if there are fewer economic investments. Wages and production prices stabilize as the demand for labor and capital diminishes, which helps keep inflation from rising as a result of company expansion. 3. Making the currency stronger. The impact that interest rate increases have on a nation's currency value is another significant consequence. Both domestic and foreign investors find the returns on assets like bonds, savings accounts, and other fixed income instruments more alluring when a central bank raises interest rates. Due to increased demand brought on by this infusion of investment money, the value of the currency tends to rise in relation to other currencies. There are several ways in which a stronger currency can aid in lowering inflation. First, imported items are more affordable when the currency is stronger. The price of imports will drop for nations that depend on them for consumer goods, raw resources, and commodities like oil. By lowering the cost of living, lower import costs contribute to lower overall inflation rates. Furthermore, the cost of foreign debt can be reduced with the support of a stronger currency. The cost of servicing debt denominated in foreign currencies decreases when the value of the home currency increases. This supports the government's and enterprises' efforts to keep inflation under control by preventing price increases in reaction to growing debt loads. 4. Cutting down on speculative activity. Another important factor in reducing speculative activity in financial markets is interest rates. Low interest rates make borrowing affordable, which incentivizes people and companies to take on more debt in order to fund speculative initiatives. For instance, when interest rates are low, investors might take out loans to buy stocks, real estate, or other speculative assets, which would raise the value of these markets. An increase in interest rates deters this kind of speculative activity by making borrowing more costly. Reduced demand for riskier investments due to higher borrowing costs may result in lower prices for stocks and real estate. Central banks can avoid asset bubbles, which frequently lead to sharp price increases and fuel inflation, by reducing speculative investment. Furthermore, fewer speculative investments contribute to the economy's transition from high-risk, short-term rewards to more steady, long-term growth. 5. Managing the inflation of wages. Wage inflation is when companies increase wages to draw and keep employees in response to growing demand and labor expenses. Wage increases might boost workers' incomes, but they also additionally fuel inflation. Higher wages are frequently passed on to customers by businesses in the form of higher prices for goods and services, which fuels inflationary pressures. The economy usually slows down as interest rates rise. The labor market cools as companies become more cautious about recruiting and growing, which lessens the pressure on salaries. Companies are less likely to have to pay higher wages to keep existing employees or draw in new ones when the labor market is less competitive. And customers may be less inclined to raise prices or demand higher pay when they anticipate lower inflation, which can aid in keeping inflation under control. The economy may avoid going into an inflationary spiral, in which rising prices raise expectations, which in turn raise prices, by managing inflation expectations effectively. In conclusion, one of the most important tools that central banks use to manage inflation is raising interest rates. Central banks can control inflationary pressures and preserve economic stability through strategies like lowering consumer spending, stifling corporate investment, fortifying the currency, and affecting inflation expectations. Let us know in the comments what you think about how raising interest rates control inflation does, and don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.